So stop hunting is for me quite a funny subject because it's almost a conspiracy theory amongst losing traders of course. If you pay close attention, you'll notice that it's only the non-profitable traders that complain about stop hunting. And that's because losing traders always blame external factors for their own losses. I've been stop hunted, my broker is against me, that's internal trading, this game is rigged. I mean, there's so many excuses. And the big problem is that by blaming others for your trading losses, you basically lose the opportunity to change and improve your own trading. So in this video, I'll share with you gold informations on stop hunting. So before anything, you need to understand why would someone hunt your stops and how do they actually do it. So a market participant, so someone or a institution, may want to hunt your stops for liquidity purposes. So for instance, I want to buy $100 million worth of shares of a certain stock. Now, what I need to be careful of with such an amount is of course liquidity. So we agree that if I want to buy $100 million, someone else needs to sell me those 100 millions. So if we are coming to support at $10 a share and liquidity is too low, that means that my order will basically be filled at a shit price because I need to find those sellers, which will obviously be at higher prices so they can make a profit. So what I may want to do is basically push down the price with large orders past that $10 support to basically catch all those stop losses. And as you know, a stop loss is a sell order. So essentially, I'm just solving my liquidity issue that I had, and I managed to buy my 100 million by basically getting all the stop losses, which are essentially selling me that 100 million. So I think you now understand why would someone hunt your stops, but how do they actually do it? So in order to hunt stops, the market participant needs to put in big orders in order to move the market. And how do they do this? Simply by seeing what's the current volume and outweighing that volume with their order in order to move the market. This is why I previously took the example of a stock, because the stock market is a centralized exchange where you know what the current volume is, so you would be able to know what volume is required in order to move the market. Now, what is the situation with stop hunts on the FX, so Forex market? Well, as you may know, the foreign exchange market is not a centralized exchange, just like the stock market. So you can't know for sure what the current volume is. Furthermore, in addition to, the FX market is the most liquid asset class you could find. And remember, why do people hunt stops? For liquidity purposes. So you need to understand that for a financial institution, it's extremely risky to try and hunt stops on the foreign exchange market or on stock market indices, because they essentially have to take huge orders in order to move the market and fill their next order. But if their huge position is not enough to move the market, they are properly fucked because they essentially took an opposite trade. So believe me, I have worked with institutional finance and they really don't care about your $50 stop. Stop hunting is not really a thing unless you look at small cap stocks, penny stocks, which I don't personally trade. So stop blaming Goldman Sachs or the fucking Rothschild family for your trading losses. Now let's leave institutions alone and look at your broker. So can your broker hunt your stops? Well, technically yes, if they are not regulated. All they have to do is change the quote you are receiving on your trading platform and basically give you fake prices, and that's it, job done. Now in reality, it's quite rare that regulated brokers hunt stops, simply because in the long term, it's not good for business, okay? Literally every single client will just go to competitive brokers. So it's definitely not a smart move for business. Now, some traders may think that the broker is hunting your stops by widening the spread. And it's the same principle here. Yes, they can do it, but it's not in their best interest to do it because they would just lose a huge amount of customers to brokers that don't do it, which essentially they would make them more money. So the reason why spreads sometimes widen very aggressively is due to low liquidity on the futures market. And 99% of the time, this happens before a major announcement, data release, or a major news. So now you can't use this as an excuse anymore. So I hope that from now on, you will take full responsibility for your trading losses and not blame banks or hedge funds. So I tried to share the concept of stop hunting in the most simple way possible and as quick as possible. So if you enjoyed this video, please leave a like and also subscribe to the channel so you don't miss any videos about trading, finance, investing, Forex, etc. So enjoy the rest of your day. Peace.